Hello investors, welcome to Business Learnings. In this video, we'll be talking about HDFC Life Insurance Company. This company is recommended by a lot of analysts, a lot of brokerage houses to be part of your long-term portfolio. We'll try to understand what's so good about this company, and we'll also try to understand the negatives, the risks about investing in this company. We'll try to understand how does this company make money. Right? So make sure that you watch the video through the end so that you get complete clarity on what's happening with this company, whether you should be investing or not, and do subscribe to the channel if you are not yet. Now, this company makes money by selling insurance policies. Right? Insurance could be of two kinds: your general insurance or life insurance. General insurance is your vehicle insurance, your health insurance, and everything else. Life insurance is in case you die, your family members or whoever nominee you have filled in, they get the policy amount as described by the policy and rules. Right now, these companies, they sell policies to a large number of people, and those people keep on paying the premiums consistently, periodically. Right, so this is how the company generates revenues. The company got its money by selling policies and getting the premiums. Right, it got the premiums. Now what does it do with the premiums? It invests those premiums. It invests those premiums in fixed deposits, in debentures, in government bonds, in stock market, and some part of that that revenue, it keeps it in cash, in liquid funds, so that whenever a new policy is claimed, whenever a policy is claimed, it can simply disperse the amount. Right. Now, in order for these kinds of companies, insurance companies, in order for them to make money, they must be very good at probability. Right? They must be very good at pricing. They should be pricing their premiums just above whatever whatever outflows that they are expecting, whatever claims that they are expecting during the year. They should have a good model at their heart so that they price their premiums so that the total amount that they collect from the premiums should always be much more than the total claims that they have to settle. Now, how do they know that what is the total number of claims that I am going to have this year? They do some mathematical models. They based on, so whenever a new person goes to apply for life insurance, based on the person's gender, the person's age, smoking habits, they predict the probability of that person's death in the next few years. Right, and based on that they charge the policy amount. So at the heart of these companies is that very good mathematical model. The better their ability to gauge risk, and the better their ability to price their products, the better their chances of, they cannot price it too low because they'll otherwise won't be able to settle claims. They cannot price it too high because competition is there. Right, so what is that sweet spot? This is what these companies have to find, except in addition to pushing for the new policies to the new people. Right, so this in very basic terms summarizes the business model of these companies. Now I have this entire agenda which I wanted to talk about, but I don't know how much will I be able to cover. Now let's quickly dive into the industry. A lot of brokerages are positive about this company just because the industry, the insurance industry, is itself very underpenetrated in India. We'll look at some numbers, and that will give you a good idea on what happens in those terms. You see, management discussion and analysis, whenever you are analyzing a company in its annual report, you should always look for the management discussion and analysis. It, in very basic terms, it simplifies the industry outlook, and it simplifies the next few quarters of the company. See, changing demographic profile. Now, answer me a very simple question: who needs insurance? People less than 20 years or people more than 20 years? Of course, people more than 20 years need the insurance the most. Less than 20 years, they don't even earn, they cannot pay premiums. More than 20 years, they have more chances of dying. More than 65 years, they have even higher chances of dying. You see, the population, 38% of the population in 2015 was less than 20 years, and this is consistently decreasing, which means that people in the higher age group, the proportion of them is keep on increasing, will keep on increasing, and that's why the number of policies that could be sold to them will keep on increasing. That's why the industry, we are very positive about the potential growth in the industry. That's not the only term. You see, life insurance penetration in India is just 2.7%. Compare it to Taiwan or Hong Kong, which have such high numbers. And even in terms of life insurance density, India is just $55 per capita, right? In Hong Kong, it's more than. Of course, I do not want to compare it with Hong Kong. We can probably compare it with China, right? Even China has about five times life insurance density. Protection gap, about in India has a protection gap of about 92 point. This figure is from 2014. Protection gap of about 92% in India, which means that if India were a person and it were to have an insurance of about 100 rupees, it's only having an insurance of about 8 rupees. So about 10 times in 2021, this number is approximately 83%. So about five times more, right? Whatever amounts the people are insured for, it's about five times less than what they should be. A clear runway for growth, for industry growth we are seeing. And I'll just post this link, and you should be going through this page, and it will give you a good idea on how the insurance industry is expected to grow. And based on what I could grasp through these pages, these charts, and seeing a double digit growth in insurance industry in the decades to come, in the next 1 or 2 or 3 decades to come, right? So we talked about the demographic profile, we talked about the insurance penetration. We didn't talk about COVID. Last year, coronavirus happened, unfortunate event. But what you should be concerned about is a lot of people are not having proper insurance coverage. A lot of people are not having insurance, and at least due to coronavirus, a lot of people got aware, right? From company's perspective, a lot of claims came. That's why the net income of this company will not be as high as it should be in other years. But it simply raised awareness across the population, which means a lot of new people will be applying for policies. And that's how the sales of this company will grow. And in the long run, it's very positive for the company, right? So we talked about the macro trends. In the industry overview, I'll just talk about how the segment is moving from public to private. Uh, two third of the premium is two-third of the premium is collected by your public sector, which is LIC. But if you talk about the new policies that are being sold, less than half the policies are sold by LIC. More than 50% are sold by these private players. And this trend is consistently improving in the favor of private players, right? Before 2000, IRDA did not allow private players in this space, and that's why LIC was the monopoly. But after 2000, as other private companies started coming in, they started offering better policies. They started selling, they started pushing their products, and that's how we'll see that private companies like HDFC or ICICI, um, their life insurance will keep on. Their life insurance industries companies will keep on gaining more and more market share. Another point is increasing concentration of top players, which means that in today's state, if you see the top five companies, the top five private players in the insurance industry, they are not, they were not capturing as much market share as they are capturing now. Which means that these top five players, they keep on capturing the market share of the bottom players. The private companies which are beyond top 10, they are losing market share to these bigger companies. And the reason is simple: the more number of policy holders you have, the better your margins become, and the better prices and deals you are able to offer. That's what has been happening with these companies. Right now, let's we already talked about the market share, AUM. Okay, this is one thing that one negative thing that I found in the slide, but you shouldn't be worried about the AUM. You see, AUM is asset under management. In 2018, it was 1 lakh 6,000. In 2019, it was 1.25 lakhs. In 2020, it's just 1.27 lakhs. The reason is we saw a big crash towards the end of 2020, towards the end of financial year 2020, which was in the March of 2020, and that's why this number, if you see now, it will be probably 1.6 lakh crore rupees, a good 30% growth, right? So there is nothing to worried about here. Yes, embedded value. This is one very important concept. I'm extremely sorry the video is getting longer because uh, insurance industry is a little different than others. That's why you will have to understand a few terms before you could understand the business. So embedded value, you cannot value insurance companies based on traditional valuation methods like your discounted cash flow or event related valuation. You have to look for the embedded value. It simply means that as of today, if the company stops selling policies, stops selling new policies at all, it won't sell any new policies at all. How much money can it generate? Because it will still generate money, because the older premiums, the older policies are still there in the market, and people are still paying premiums, and they'll keep on paying premiums for the years to come, right? And if the company stops selling any new policies at all, how much value will it generate from its existing policies? That's what embedded value is. And the embedded value of HDFC Life is about 20,000 crore rupees. And market cap of HDFC Life is about 1.4 lakh crore rupees, right? 1.43 lakh crore rupees, which means the investors, this is about 7 times the embedded value. Embedded value should be the true value, but it's not so, because we expect HDFC Life analysts, the people who have given this kind of valuation, market thinks that HDFC Life can sell 7 times more premium, more policies than it has at this point in time. And I think that it cannot just sell just 7%, just 7 times. It can sell probably 30, 40 times, just because of the sheer runway for growth in the industry. And that's why I still feel that the valuations are still cheap, but that's my perspective, right? Uh, Number of lives insured, again, you can find that in the same slide. It's growing at about 15-16% CAGR per number. Now let me just talk about the strengths and the weaknesses uh, in short. Solvency position simply means that better position to settle claims. How much cash do you have? In basic terms, how much liquidity do you have? Right. IIDA mandates that should be 150%, and HDFC Life has 190%. Great. Strong distribution network, bank and BFCs, new age distribution, and it's moving away from bank assurance. Now, let me tell you what bank assurance is. HDFC Life comes from the same promoter group from which HDFC Bank comes. So, a lot of policies that HDFC Life sells, it is sold to the customers of HDFC Bank, right? And that is a problem. That is a problem because HDFC Life becomes very heavily dependent on HDFC Bank, which is not a good thing if it wants to go international, or if it wants to reach out to customers who are not present in HDFC Bank. So the company is doing away from bank assurance. Bank assurance means selling your product through your bank, right? It's finding new partners, it's finding new age distributors, and that is a very smart move by the management, in my opinion, and it has been able to do so. 5 years ago, it was selling more than 75% of its policies through HDFC Bank, And now just 55% of the policies come from HDFC Bank. They are planning to decrease it to diversify their risk, which is a very good thing, right? GWP is gross written premium, and it has been growing about 17% for the last 5 years. Again, just to clarify, it's plan to be collected, not yet collected, because all the policies that are sold, premiums on all of them are not collected. There will be some people who will not pay premiums, right? Consistent product innovation. Again, I'll talk about moving away from ULIP. ULIP is unit linked insurance product. What happened was, about 10-15 years ago, insurance industry started focusing a lot on ULIPs, and it 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 sold good. It sold good because ULIP is a combination of insurance and investment. About 80-85% of the money goes in investment, and the rest 10-20% is used to cover your insurance, right? So good deal, right? Two in one. But as it turns out, it's not good for the consumers. It's not good for the companies. It's not good for HDFC Life because it's a very, very thin margin product. So they'll have to sell a lot of tulips to generate a very small amount of money. Reason number one. Reason number two, from consumers' perspective, they neither get a good investment return, nor do they get a good cover, a good insurance cover, right? So they are thinking they are getting both these things, but they are getting none of them right. And that's what the problem with ULIPs is. And HDFC Life realized it, and it has started bringing down the contribution of ULIPs throughout the last 3-4 years, which is a very good thing, which shows that HDFC Life understands the business and it's consistently improving. And ULIP was just an example. It has done many such innovations. It listens to the users, consumers, and based on that it innovates its products. And that's one of very positive things about HDFC Life.